Morning, I hope you're doing well. In today's video, I would like to address a question that was asked regarding financial advice and financial planning. I had recently made a post on LinkedIn talking about the role of government schemes in our investment portfolio, and the example that I cited was that of the sovereign gold bonds. So, for example, here in various screenshots, I have highlighted some of my positions on the gold bonds, and I spoke that how certain fundamental changes in gold back in 2013 to 15 increased the odds that the demand for gold would increase. And when the RBI started selling gold to the retail consumers, I found it difficult to not buy it because there was a gut shot chance that gold could give a multi-year breakout. And as it looks, as we can see that certain bonds are given 200%, 100%, 150%, etc. It looks in hindsight that that was a good decision. Regardless, I shared the positions that I have in gold bonds and how they are capital gains exempt, how they have literally no cost of procurement, how there is no chance of theft, etc., and the many benefits that are there of having electronic assets which are sovereign backed by the government of the country. I also shared my leftover mutual fund portfolio. So as you know that I started trading in 2015, and I have been in the market predominantly as a trader. There have been very few investments that I have made during the process. I only started actually investing in 2023 when I had created a sufficient enough capital base out of trading that was worthy of being invested in the market. Till that much time, all of my efforts were on short-term trading. I used to use the principles of short-term trading to even buy mutual funds. And what I used to do is I used to sort the mutual funds in groups of expense ratios. Then I used to plot their line charts. By I means there were softwares which had the line charts, and I would do the same analysis that I would do on any other stock. Just the difference was that instead of candlestick patterns, I got a line chart investment. And when I felt the need to buy into, have at least 100,000 rupees, into US and Japan, I bought funds which basically invested directly into these countries. And in order to buy those funds, I paid an expense ratio of 2 to 2.5%. So it's really, really costly. The other mutual funds that are left over into my portfolio are at an expense ratio of 1%. And these investments must have been somewhere around 2021, 22, or maybe 23, maybe. I do not know. So I spoke about how NPS offers the exact same benefits as mutual funds with the exception of exposure to an international market, and which is the reason why I paid the 2.5%, because even if I were buying a flat, I would pay about that much as brokerage to a broker. So I thought that it is worth a small investment into another country, just as a diversification. And also when I was analyzing the charts of those markets, I found that there is justification to attempt a long in those markets. I just didn't know how, and I thought that these fund of funds, etc., would be a reasonable play. In that context, the question that I got from Puneet on LinkedIn was that what would be my advice for someone young who wants to balance between safety and growth, and how should they approach diversification, and what would be the perspective of someone who's more experienced in this process. So I would, through Puneet's question, I would like to give an advice in the form of a general framework which is applicable to many people, or perhaps almost all of us between the ages 20 to 60. So it's not just restricted to 20. And and what I'll share next is my actual perspective on the subject. So here basically I have just created a very, very, very small table, and what I'm saying is that let's assume you are the only member of the house. If you are the only member of the house, then the bare minimum, so I'll just call this table 1 as bare minimum standard investments. Okay, this is bare minimum standard investments. So there are exceptions to this, but we will discuss those exceptions. Those exceptions will be applicable to a very, very, very small percentage of people in the world. So the bare minimum expense that you want to, standard investment that you want to have is 1.5 lakh rupee in PPF and 1.5 lakh rupee in NPS. Now just remember, NPS is a fancy word for basically government owned mutual funds. Okay, and where a mutual fund typically has an expense ratio of 0.5 to 2.5%, and NPS has an expense ratio of 0.04 to 0.09%. So it is anywhere between 1/10th to 1/30th the cost of a mutual fund, depends on how we see it. So NPS also is going to give you long equity exposure, much like a mutual fund, with some component of debt to it. In other words, if the market, just visualize that you're investing for 30 years and the markets are truly exploding, like they're 10x, 100x from the current levels, then the mutual funds are going to do well, and so is the NPS. But the difference is going to be the tax savings that you get out of NPS and the structurally low cost of the instrument by itself, which is going to maximize your savings. So, for example, a mutual fund gives 12% CAGR returns, right? And obviously, if there is an expense ratio of 1%, then your actual net returns are going to be 11%. And on that 11%, you're going to pay approximately 16% tax, long-term tax, 15.97%. You know, you'll add cess, etc., everything. And you will be left with approximately 9.25%. You need to understand that a PPF is also going to deliver around that much, 7.5 to 8%, but with zero risk. Like, you have no risk in this, because there is a gut shot chance that your mutual fund will not return you 12%. It's rare, it's difficult, but it is possible. It is difficult to assume that because the market is likely to be bullish for a decade or so. And NPS, I feel, will do well under the same circumstances that a mutual fund does well. But the fact that you are doing something at such low cost and forever, like you're putting this 1.5 lakh year after year after year, your corpus will be huge, and 1-2% of that is very, very big amounts. We're talking huge amounts. So that is my perspective, that if you let's assume you were just saving 1,000 rupees. If you were just saving 1,000 rupees, then I would just put 500 rupees in a PPF and 500 rupees in an NPS. If you were saving 10,000 rupees, I would make this 500, I would make this 5,000 PPF, I would make this 5,000 into NPS. The maximum possible that you can go is 1.5 lakh rupee. While in the NPS, in theory, you could invest more, but I feel that there needs to be a 1:1 ratio between your debt fund and your equity fund. You need to have that 1:1 ratio, because you need to assume your average age at the time you need the funds is going to be 50. So a 50-60-year-old person needs to have debt allocation at that stage, and it needs to be on a huge corpus to be able to make sense. Otherwise, if you just put 10,000 rupees in debt, you're not going to make anything out of it. You just wasted your time. I mean, on paper, you're going to make interest, but the cost of documentation, the cost of reporting it to your accountants, the cost of filing it, all of that is just not worth if the investment size is too small. So therefore, this should be your first step. And if you do these two things, this will allocate a saving of rupees 3 lakh in a year. And to save 3 lakh rupee in a year, you need to be saving 25,000 rupees in a month to be able to do that. Now, let's assume you save more than 25,000 rupees a month, and you take another jump and you are now saving at 50,000 rupees a month. Like, you're saving this money, and saving 50,000 rupees a month is automatically in the top 1, 2, 3 percentile of the country, just to be clear. So if you're saving 50,000 rupees a month, then chances are that you're no longer just 20, perhaps you're 30, and either you're going to or you already are married. In that case, it makes tax sense to gift your wife the 1.5 lakh in PPF and NPS and buy the same thing for her, right? And this will take care of now a total of 6 lakh rupee, which means 3 lakh rupees is the plan that you did for yourself, and the same 3 lakh rupees you executed for your wife. And now you will ask, like, why for the wife? Why shouldn't I just directly buy into a higher interest generating mutual fund or something like that? I'll come to all that aspect later. Not like very late, just in a few minutes. So yeah, the point being that you're going to do this, or my recommendation is that you do this, that the 1.5 lakh PPF and 1.5 lakh NPS goes to the spouse. Now you start saving 9 lakh rupee a year, which is you're saving 75,000 rupees a month, which means you should be drawing a salary close to 2 lakh rupees a month in order to save that much kind of a money. Then and to do that with a child, we already know that now we are looking at top 1 percentile now. Like, very few people are going to be able to make it till here. It's not easy. But if you have that, you will replicate the same process for the child also now, and this will take care of 9 lakh rupees of saving per year. But if the child happens to be a daughter, then in that case, instead of 9 lakh, you will have to put a Sukanya Samriddhi Sukanya Samriddhi scheme 1,50,000, which means if you have only one child who's a daughter, your investments for the year are 10,50,000. But if you have two children and one of whom is a daughter, then the investment will obviously become 13.5 lakh rupees. And obviously, if both are daughters, then in that case it will become close to 15 lakh rupees a year. Now, the point that I'm making here is that anywhere, whether you're saving 500 rupees a month or if you're saving all the way up to 1.5 lakh rupees a month, I believe the government small savings schemes have you covered already, right? And now you would now coming back to the question as to why am I saying that even though you are earning, you should start gifting your family members a small amount of money time to time, because if you end up earning too much and your tax slab jumps too high, you will pay 42.7% as tax. And every income that you generate, whether it is rental income, everything will start coming under a higher slab. And let's assume your wife is not working, she's just staying at home. It is impossible for you to be able to someday buy a house on her name if she has no income source to begin with. And this is what my point is coming. When my my parents are from Jammu, and my dad left Jammu for a job, and his first job was in AFMC in Pune. Then he quit that and joined a private company for his veterinary role. And when I was born, what he did was he simply started off with a PPF for me. There was no NPS or obviously no question of Sukanya, etc. But he started a PPF for me, and simultaneously he started a PPF for my mother. And he also was obviously investing in PF and PPF because he was an employee. Now it didn't look like much. He's a very disciplined investor, which means that on the first week of April itself, because these are debt funds, he would just put the entire money as was available with him. So if he had 10,000, he would put 10,000. If he had 50,000, he would put 50,000. It was not even the full amount because that much amount was not there to send. Now by the time I became 15 years old, there was a possibility of a withdrawal, but I think we withdrew much later, like maybe 18 or 20 years old. We withdrew the PPF, and the PPF simultaneously matured for my mother and myself. And what my dad did with that money is he outright bought a small house, a flat. I mean, this was just an outright purchase, no loan, no nothing. Outright a small house was bought, and that house basically, I do not know exactly how much money we got, but in both PPFs, I think it was close to about 70 lakhs or 75 lakhs, just compounded over the years. You must understand that by the time, you're putting 1.5 lakh rupee a year, and it is generating an 8% interest, let's say, for example. On the 15th year, that base which is generating 8% interest is huge. So you want to let it run. And these are all tax exempt. You must understand that this tax exempt thing is a very, very big deal. It's a huge deal. So this is a lot of white money, a lot of clean money which is just getting saved. And so PPF and NPS were assets, or NPS was not the case for us, but PPF were as asset. And when that PPF got matured, that asset got replaced by another asset, which was a house. That house generated income based on which we again funded the PPFs. Right? So I'm close to 40 today, and I'm pretty close to realizing my next PPF also. I do not know exact age, I don't track it to that extent, but I'll just check and I'll let you know when it comes. But I'm sure that it's going to be a sizable amount. Point being that when your PPF alone matures, it is good enough for you to be able to buy an asset outright, and that asset will create an income source for you. So if you accelerate in your life, that is, you're saving more than 13.5 or 15 lakh rupees a year during the course of your career, good for you, good for you. But in the event you are not, then just give it 15 to 20 years of your investment, and you will replace your small debt and these NPS products with actual real tangible assets like a house or a small office, which will create income for you for the rest of your life. What I shared with you is my is a reality that I benefited from, that my father invested in PPF under my name for the longest period of time. And because the PPF was invested under my name, so the house that was bought also had to be under my name, because that was my PPF that was going. And consequently, unknowingly, at the age of 2021, I am generating a rental income, even though that income is very small. But the fact is that there is an income that is coming in, and it really starts securing. So his efforts, his decision to take a secure position in the market allowed me to reach a level where someday I could take risks in the market, right? So if you are very early into your savings, so let's say for example you are in the same process where, say for example, my previous generation was, but you are in that process today, then I believe that the advice for you cannot be much different. The advice for you is the exact same, just that we will factor in the additional financial instruments that are there in the market. And I believe that the Indian market is so bullish, it is so bullish that we are so fortunate to be a part of it, that it gives me confidence to recommend NPS also. But because I am very conservative by nature, I have still given a 1:1 ratio. That means I'm not saying park the entire 15 lakhs into NPS because it is cheap and the market could one day explode. This process has to be followed. Each family member has to have a certain amount of assets under their name. Those assets need to be highly secure so that someday they can be transferred into a little bit riskier asset class like real estate. And this process of your life should continue uninterrupted, and till you are saving. Again, we are talking saving, we are not talking income. I know a lot of people mistake that. It sounds so similar. Unless and until you're saving 15 lakhs a year or more. Now here I'm adding 15 lakhs, and if I just add another component like insurance, like health insurance or something, you will just add another, I don't know, maybe 25,000, 30,000 rupees premium more if on a family floater. It just depends on some conditions. So it's my view, unless you're saving 15 to 20 lakhs a year, that is, this needs to be a saving. Unless you're doing that, there is absolutely no need for you to go around looking for any financial advice anywhere. Do this first, okay? Like, just do this first, all right? And इसके बाद भी अगर आपका पैसा बच रहा है, ठीक है, like after putting in, like, you know, like for example, I can talk about my family for sure. My parents are there, but we don't invest in PPF for them because my parents are in early 70s. So they have superannuation, etc. These are separate products that we can talk about that later. So I have family of 4. This is the exact family: myself, spouse, child. That is, my first child is a daughter, and the second one is a son. So this is actually like what I'm doing in the family. Like I do all. So the practice is that I invest in PPF for all 4 of us. So that's 6 lakhs rupees a year gone straight off. 1st of April means 6 lakhs rupee is gone. Daughter is going to get that additional 1.5 lakhs. So now 6 lakh becomes 7.5 lakh rupee gone. All right. Ideally, I should be spending another 6 lakhs rupees in national pension scheme. But the thing is this, that I am very heavily invested into equities myself. Like it is far greater than 6 lakh rupees. So the national pension scheme, and I have maxed out the tax benefits here. So the national pension scheme, because I'm an active investor in the market, I actually do this every day. Like there is not a day that is possible that I would have not seen at least something in the market. So because I'm so actively invested in the market and I'm applying myself in the market, it's the reason why I don't have this. And instead of having, let's say for example, 6 lakhs rupees equivalent on NPS, I have the gains from my trading contributing towards creating gold and equities, directly equities. And I know the NPS service providers. I also know what equities they hold in their portfolio, what weights are given. All these details are just available. All I have to do is plan my trades, and that is all that I'm doing. And therefore, I feel at some level, I feel I can plan my trades better than them. I can plan better than they can plan for me. And therefore, I have not done this. But if you are, let's say you're a doctor, or you are, let's just assume you're from finance, you're a chartered accountant, but you are an actual accountant, which means someone who's going and working in that field, like you're auditing and you're doing all of that work. You are not going to be able to spend perhaps 1/10 the time that I can give to the market. That's the practice. Also, you don't love trading as much as, let's say for example, a professional trader. Like we enjoy that process so much more. So you are better off going here. Okay, you are simply better off going here, and so that you are creating a base secure enough for you so that you can excel in your industry. Your true growth is going to come from your industry. So again, to sum it up, financial advice is only applicable to those people who have money. Okay, if you don't have money, there is only one piece of financial advice for you, and that is you need to work hard wherever it is that you're working. Whatever is giving you 1 rupee, 10 rupee, 10,000 rupee, that is what you have to work at, and you have to ask yourself, how do I get more? When you have money, some savings and you have provisions for your liabilities, this is the plan that you're most likely going to follow, and this will take care of you for a very, very, very long time. When you cross this also, at that point in time, there a time starts when you're earning more than, when you're saving more than 25 lakh rupee a year, then you're typically earning also more than 75 lakh rupee a year. And it's very easy to, a person's net annual income multiplied by 40 is more likely going to be the net worth. So 75 lakh rupee a year, a person is most likely 25 to 30 crore rupee net worth. That kind of a person is most welcome in the market. And at that time you can decide like what you want to do in the market. Do you want to come into the market in terms of growth through leverage in FNO, or if you want to get into equity, enjoy the dividends, you want direct dividends getting credited to your account, not like some random stuff, then yes, then I feel that that's the right segment for the market. And yeah, with around 10 like 1 lakh rupee salary per month, or 5 lakh rupees saving per year, you could have traded FNO, but that was in 2015 to 20. Once Madhabi Buch, the SEBI chairperson or whatever head of SEBI, once she altered the rules of contract sizes, STTs, margins, etc., I'm telling you, you can take it from me, FNO, NSE FNO is no longer applicable for individuals who are saving less than money. You can take your risks and you can have fun with that process, but you should know it that you are taking risks that people who take risk for a living find risky. Yeah, like I don't know, I might have like 50 lots open or something. I don't know how much I'm risking right now. It could be quite a bit, but I feel that what I'm doing is far less riskier than what this person is doing, the person who's not even saving this much and is in the market. So with that, I hope I have answered everything. That in order to balance safety, you're going for PPF. In order to balance growth, you're going for NPS. You will approach diversification only when you're saving more than 25 lakh rupee a year, at which point you will decide whether you want to diversify yourself or you're looking for individuals to diversify on your behalf. If you're looking for individuals to diversify on your behalf, then you are going to be a client of Portfolio Management Services as a company, which is a separate study. If you're looking to diversify it yourself, then you will become a student of the market. If you do that in the leverage segment, then you will be short-term trading, and if you are profitable, you will become a professional trader. But all of this is only happening when your family is somehow being able to save more than 25 lakh rupee a year. It could be because of your efforts, it could be because of your parents' efforts. Maybe your parents, like for example, my dad bought a house for me that in turn got me rent. Now that house is appreciated much more. All of that, I benefit from it, and because I benefit from it, I can take those risks. But having said that I benefit from a stable financial background, it doesn't mean like my father is Tata or Ambani or something like that. It's not even like that benefit. It is just enough to justify taking certain risks in the market. So till you reach that level, till you reach that age, till you reach that amount of saving, I don't think so you should be going directly in for diversification yourself. Your PPF and NPS will do the job for you. With that, I hope that in today's video we have covered some points which will be useful not just to you as traders but to the audience in general. My average audience is age 35 years old, and the people that I speak to are actively into trading. They trade FNO full time, and most likely we have engaged through our lectures in Upsurge. So there is a possibility that this video might not be directly applicable to you, but if you feel that the advice that I have shared makes sense to a conservative person, or to a person who's who's trying to lead a life where you're taking responsibility of yourself and a few other people also, like it depends what you do, then in that case, if you feel that this makes sense, then do give this off. Because I'm telling you, everyone is selling mutual funds because you get a commission out of it. Everyone is selling crypto because you get a commission out of it. People are asking you to do all sorts of things, and if you look at the underlying cause, is because somebody is getting a commission. No one is telling you to go for Sukanya Samriddhi, PPF and NPS, even though these are the best financial instruments in the world, perhaps for Indian citizens. I mean, it's like for us directly, because they are so low cost that they offer absolutely no commissions. There is no kickback given to anyone. And in fact, I'm telling you, buying NPS is even cheaper than buying liquid Bs. It's that cheap. The price cannot go lower. And I think that campaigns should be run to encourage NPS. NPS has one drawback though, that they don't encourage withdrawal of money right up till 60, and then that becomes your superannuation and annuity. That is a withdrawal. So someday, that's a feedback that we should give to the government of India, that there must be a government of India run mutual fund, right? Like which we can liquidate whenever we want. That is the problem with the NPS, that you simply cannot withdraw the money. Same is the case with the PPF, and same is the case with Sukanya. You cannot withdraw the money. So in other words, I'm not just talking about 3 lakh saving. I'm talking about legit 3 lakh good saving. That kind of saving which you are not going to need at all. You have buffers for that, like layers of buffers in it. And I'm telling you that this in itself is applicable to less than 2% of the country at the time that I'm speaking. Obviously, I hope that sooner or later it will be applicable to more of the country. And all your base decisions are going to be a function of how much is the government allowing. If the government allows 1.5 lakh of PPF, you will do 1.5. If the government makes it 1 lakh, then you will change this and make it 1 lakh. Okay, if the government makes it 10 lakhs, you will change it and make it 10 lakh. My point being that there is a reason why the government would have come up with those slabs. So you need to either try hard and understand those reasons, or simply assume that they are correct. So whatever is the debt allocation, that much is your NPS allocation, because you don't want to be taking risk. The only time you take risk is when you are you are directly involved in the game, you have an expertise in the game, you have the skill set and the willingness to take risk. Okay, everyone takes risks in their life. They just take risks not in the direction of high growth, they take risk in the direction of high confidence. For example, when a person who's skating or doing those you've seen in Western countries and often in media, roller skaters, and they're just doing all the parkour athletes, jumping from one building to another. They're taking huge amounts of risk, but they back it, but they're confident about it. Okay, if I'm trading FNO, I'm taking a huge amount of risk, but I'm confident about it. But if you ask me to become, let us say, for example, to sell a book, take inventory of 10,000 books and distribute, I can't take that risk, even if I can afford it, because I don't understand that industry. I don't know how distribution works. I don't know where I'll store it, what I'll do with it if a mouse attacks it. I just don't know so many things. So I'll not venture there. So everyone takes risks. You will take risks in the area of your knowledge. If that area of knowledge happens to be the market, you are most welcome and you will come directly into the markets. If not, then these are the products for you, and this will be applicable to, I don't know, almost the entire country with a few exceptions, give or take. So with that, I hope I've addressed most of the questions. We are at almost 8:35, getting ready for the market open. So I wish you all the best for today's trade session and the days ahead. Take care.